You work hard for your money, right? You
Right.
put in the time, the effort.
Absolutely. That's the standard path for most people.
But what if your money could sort of work hard for you? Maybe even, I don't know, while you're sleeping or doing something else entirely.
Well, that's a fundamental shift in thinking, isn't it? Moving beyond just trading hours for dollars. It's about getting your assets to generate income for you.
Exactly. And that idea, that's really what we're digging into in this deep dive. We've looked at a bunch of sources talking about how adults build wealth and, importantly, how taxes play into different kinds of income.
Right. And there's one specific strategy involving rental properties that these sources really zoom in on because of its significant tax implications.
Yeah, so our goal here is to pull out the key takeaways for you from this material. We want to understand the differences the sources highlight between income types.
And really unpack the mechanics of this renter property strategy, especially how it connects to taxes.
When we talk about concepts the sources bring up, like busy money versus sleeping money.
Which are basically active versus passive income, just using more, let's say, vivid terms.
Yeah, vivid. And something they call the big shift. Plus, this kind of fun term, the invisible friend, which sounds mysterious, but is apparently key to the tax side.
It might sound a bit different, yeah, but the principles underneath are pretty standard financial concepts, just maybe explained in a more relatable way. We'll try to cut through any jargon and just get to the core ideas presented.
Okay, cool. So let's dive in. Started with the basics. According to these sources, what exactly are taxes in this picture?
Well, the sources frame them pretty simply. Basically, as a fee, a contribution citizens pay to help run the country, fund public services.
Right, like paying for roads, schools, parks, the stuff we all kind of rely on.
Exactly that. It's presented as chipping in for the common good. But, and this is crucial, the sources also stress that understanding the tax rules allows people to manage their money better.
Meaning they might be able to legally reduce how much tax they pay.
Precisely. It's positioned not as dodging taxes, but as being a smart financial citizen, like finding a secret shortcut, almost using the existing rules efficiently.
Okay, so navigating the system smartly. And a big piece of that puzzle, these sources say, is realizing that not all money you make is treated the same way by the tax folks.
That's a key distinction they make. They talk about two main types using their terms, busy money and sleeping money.
All right, let's define those. What's busy money?
Busy money, or what's typically called active income, is, money you earn directly from your own work. Your job, maybe a side gig like washing cars in their example, you're actively doing something to get paid.
You're literally busy earning it. Got it. Okay, so what about the other kind? The sleeping money. Sounds more appealing.
Yeah, sleeping money or passive income is money that comes from assets you own, stuff that makes money for you even when you're not, actively working on it day to day.
Like investments.
Or rental properties, which is the big focus here. The sources even describe it like having a superhero earning money for you while you sleep or do other things.
A financial superhero. I like that.
Yeah.
Okay, so why is this sleeping money treated differently when it comes to taxes, according to what we read?
The idea presented is that governments often want to encourage certain activities like building things, investing, providing housing, things seen as good for the economy.
Okay.
So because sleeping money often comes from these kinds of investments, the government sometimes gives little thank you breaks or tax benefits as an incentive.
So the tax system is kind of nudging people towards certain investments.
That's the implication, yes. And the big takeaway the sources emphasize is that these tax benefits can mean you get to keep more of the sleeping money compared to the busy money you earn.
Interesting. And the sources really hone in on rental properties as a prime way to generate this tax-advantaged sleeping money.
They do. It's presented as one of the most popular and effective ways grown-ups do this, according to the material we reviewed.
So, walk us through the basic mechanics. How does owning a rental property generate this sleeping money?
It's pretty straightforward on the surface. You buy a house or apartment, you rent it out to someone, and they pay you rent each month. That rent money is the sleeping money.
Okay, income coming in regularly without you having to, say, clock in somewhere. Now, here's where it gets interesting with taxes. The sources talk about this invisible friend. What's that about?
Right, that's their playful term for a really important tax concept. Depreciation. This is one of the major tax advantages they highlight for rental property.
Depreciation. The invisible friend. Break that down for us.
Okay, so depreciation in this context is basically a deduction the tax rules allow. The sources explain it like this. The government lets you pretend that the building part of your rental property is losing a tiny bit of value each year, getting older, wearing out.
Pretend. Even if it's actually like appreciating in value in the real world.
Exactly. That's the key point they make. It's a tax calculation, separate from market reality. This annual deduction, this invisible friend, reduces how much of your rental income the government considers taxable.
Huh. So it lowers the income figure that taxes are calculated on, even though you actually received more cash.
Correct. They give an example. Say you collect $100 in rent. Depreciation for that period might let you deduct, let's say, $30. So for tax purposes, it looks like you only earned $70 from that rent.
Even though you have the full $100 in your hand.
Precisely. You have the $100, but you only pay income tax on $70 of it. That's a big part of what the sources call the magic with rental houses.
Wow, okay. It seems significant. And is depreciation the only deduction? The sources mentioned other things, like fixes and fun.
Right, good point. No, depreciation isn't the only thing. The sources also emphasize that you can deduct the actual money you spend on running the property. Think repairs, maintenance.
Like fixing a leaky faucet, painting a room, maybe hiring someone to manage the place.
Exactly those kinds of things. Property insurance, property taxes, even the interest you pay on the mortgage for the rental property. These are all considered business expenses for the rental.
And how do those affect the taxes?
Well, similarly to depreciation, you subtract these costs from the total rent you collected. The idea is you had to spend that money to earn the rent, so you shouldn't be taxed on the income that just covered those necessary costs.
So both the invisible friend of depreciation and the real cash expenses work together to lower the taxable amount of that rental income.
That's exactly it. They both chip away at the profit number that the tax authorities actually look at, can shrink it quite a bit.
Which leads us nicely into what the sources call the big shift. This sounds like the overall strategy.
It is. It's the strategy of taking your busy money, your earnings from a job, and consciously converting it into assets, specifically rental properties in this case, that generate sleeping money precisely because of these tax advantages.
How does that shift work step by step, according to the sources?
Okay, so they lay it out like this. First, someone earns a good amount of busy money. Their example uses $200,000 earned in a year from a job.
Okay, a substantial income.
Yes. Then, instead of just spending it all or saving it conventionally, they take a really big chunk of it. The example uses $189,000.
Wow, most of it. What do they do with that $189,000?
They use it as a down payment to buy a rental house. You know, that first big payment you make when you buy something expensive like property.
Right, so turning earned cash into a physical asset.
Exactly. And then the magic happens, as they put it. The house starts bringing in rent. That's the sleeping money.
The asset starts producing its own income stream.
Correct. And at the same time, those tax benefits we talked about kick in. Depreciation, the invisible friend, plus all the deductible expenses for repairs, management, interest, etc., start reducing how much of that rent money is actually taxable.
And the sources give a pretty dramatic example of what this can do to someone's overall tax situation.
Right. They do. It's quite striking. They suggest that even though this person earned $200,000 from their job, after buying the rental property and applying all those deductions like depreciation, for tax purposes, their total taxable income might plummet.
Hello.
In their specific example, it could look like they only earned $11,000 that year, purely for tax calculation.
Wait, earn $200 K in reality, but the tax system only sees $11 K. That is a massive difference.
It is. And the direct result, as highlighted in the sources, is that they end up paying way less in overall income tax than they would have otherwise.
Okay, I get the tax benefit, but I have a practical question. If they paid almost all their $200 K earnings, $189K into the house down payment, how do they, live? Pay for groceries, bills?
Yes, very practical question. The
Right.
sources address this. The idea is that while the initial purchase uses the busy money, the ongoing income from the property, the sleeping money, the rent coming in each month, can then be used to cover living expenses.
Okay. So the busy money buys the asset, but then the asset's own income, the rent, starts funding your life, potentially with a much lower tax bill attached because of the deductions.
That's the clever part they describe. You use the rental income for food, clothes, fun, whatever, all while benefiting from that smart house trick that lowers your taxable income significantly.
Makes sense. The sources also used a nice analogy to wrap this up, didn't they? Something about a tree.
They did. They compared buying a rental property to planting a money tree.
A money tree. Love that visual. How does the analogy work?
Well, The idea is you put in the initial effort and resources your busy money to plant the tree, which is buying the house. It takes that upfront work.
Right, the down payment and finding the property.
Exactly. But once the tree is established and growing, it starts producing fruit, the sleeping money, the rent, without you having to constantly put in the same level of active work as you did to earn the initial busy money.
So initial heavy lifting, followed by more passive rewards.
That's the core message of their money tree analogy, yes. Takes effort to start, but the benefits keep coming.
Okay, so let's quickly recap this deep dive based on the sources. We looked at taxes as, necessary contributions.
But also how understanding the rules, especially the difference between active busy money and passive sleeping money, is key.
Right. And the sources really zeroed in on rental properties as a major source of sleeping money, highlighting those big tax benefits, depreciation, the invisible friend,
and deducting all those operating expenses. Both work together to really lower the taxable income from the rent.
which enables what they called the big shift, using busy money to buy an asset that throws off sleeping money and potentially slashes your overall taxable income, like in that $200K down to $11K example.
Allowing the sleeping money, the rent, to potentially cover living costs while you benefit from lower taxes overall. It's about building assets that work for you.
So for you listening, the sources offer some parting thoughts. They really stress saving money. You need that initial capital to plant these kinds of assets later.
Yeah, and continuously learning about money, about investing, and trying to think more like a business owner. How can you make your money work for you?
They do make a point to say, look, paying taxes is important. It funds the country, the roads, the schools.
Absolutely, it's essential. But being smart about generating sleeping money and utilizing the available tax strategies is presented as a perfectly legitimate way to build your own financial future and keep more of what you generate.
It's about playing the game by the rules, but playing it effectively.
Exactly, working within the framework that exists.
So maybe a final thought for you to chew on from all this. If the big goal is having your money work harder for you, what's maybe one small thing you could look into or learn about this week to just start thinking differently about income? Or maybe even spotting a potential invisible friend or planning to plant your own little money tree someday?